Let me say this very, very clear for the folks in the back of the room. I want mortgage rates to stay at 7% for the next 6, 9 months. We're going to have this conversation with Dustin from Convoy Home Loans, who might want to reach through the screen and punch me in the face, but thankfully he can't do that. The technology doesn't work that way. How you doing, Dustin?
Good, how are you?
Doing well. What? How does that hit you? Right, you're in the mortgage business. I have to imagine your business does better with lower rates, obviously. But given where we have been together over the last 2.5 years, with what we started to see when rates were 6.5, I am screaming, just just stay at 7 and call it a day for 6 months, and I'll be happy. What do you think?
No, I agree because I think what you're alluding to with the 6.5 is that we saw that drop and it was a 0.5% drop over a 1 week period, essentially from end of December to January. And the uptick that we saw across the country, now I can specifically talk about, Convoy and our company. The uptick that we saw wasn't healthy in terms of the amount of applications, the new bidding wars, the 1 month increase in values on properties that were listed for 4 months getting nothing, now all of a sudden getting 10, 15, 20% over asking price,
I
here
saw
in
that.
Los Angeles and Southern California. That's not healthy. So what we want, if I'm trying to be biased but also unbiased,
Yeah,
being the owner of a mortgage company, we just want a slow, very, very
yeah,
slow comeback. Now, 6 months, 9 months, the rest of the year, I'm fine with rates staying at 7 because
yeah.
we're everybody that's been operating in the last year and a half that's still here today should be fine with 7.
Yeah, I agree
It's
with that. I agree with that. Yes.
Yeah, it's the people that have been sitting on the sidelines, and I'm not just talking about potential, new homeowners or investors, but also loan officers, because what we saw in I want to say it was like the very last week of December to essentially the last week of January,
Mhm.
was the amount of old loan officers that tried to flood the market really, really quick. Okay. And because of that, you're going to get a lot of people that are speaking to loan officers that may not have the experience over the last year and a half, getting advice from people that will just, or from loan officers that will essentially do anything and everything just to get your deal in, but not have any intention or care or wherewithal on how to
Mhm.
get this closed. That's the biggest thing.
No, I so again, I saw the same thing, and you're absolutely right. It was like to me, it was like December 15th, maybe December 17th to the end of January. I just saw, and again, let this channel, right? I talk to mortgage brokers, I talk to agents, I talk to investors across the country, and the behavior that I started to see from quote unquote the masses, it was worse than early 22, almost, and I hope people realize how bad this is, almost as bad as early 21. Early 21, if you don't recall, was when we had record low inventories. And it was not uncommon to have six-figure over asking wait, dude, releasing EMDs. When you get to a market where you're releasing EMDs, earnest money deposits, I freak out. That is not okay. And that is what I started to see at 6.5. I don't want it. I don't want it. That's not good. That's not good long term for housing, in my opinion.
And what's terrible is you bringing that up brought me to just a current situation that I'm in right now with a client. A client got under contract 2 weeks ago, so the news basically being able to properly be passed down to the seller and my buyer that rates are going up and we're not in the environment that we were at the
Mhm.
first week of January,
Right.
caught them. My buyer
Mm.
had to get a 2 week extension, or not a 2 week close of escrow. Okay. I told him, like, look, I'll rush it, but this is going to be hard in this market. He said he had to put a non refundable EMD down.
Oof.
Now, our close of escrow is actually today. I had to tell him over the last 2 days, like, look, I'm realistically going to need another week, maybe 10 days, because I just can't pull off a 30-year fix in 2 weeks right now. Um, so he went back to the seller, and the seller's like, you got to give me another 5% of the purchase price as a non-refundable EMD. And why that, kills me is because the sellers right now shouldn't be in that sort of
Yeah.
position negotiation wise to be able to dictate that from buyers in this current market. But they got it because
Yeah.
everybody still thought, January was the new norm and we're heading straight down to 4% again.
No, that, and again, I've been studying the consumer. I study the consumer because if you watch them, they become very predictable. And what I called on December 17th, it called early, but called right, was what happened in January. The consumer is so predictable. You want to know when 6.5% mortgage feels great, it feels like a deal. When you're used to 8.
Yeah.
And that's what we had. And again, we had kind of a slow second half where the marginal demand was contracting. And then we go from 8 to 6.5, and it's like a release of pressure in a pipe. It just came flooding out, and in this, and we didn't have any more inventory, right? It would be one thing like if rates went to 4.5. Let's just pretend for a moment.
Okay.
This is going to be wild. I actually think a 4.5% rate would be better than a 6.5% rate. Why do I mean that? Because I believe at 4.5, you would unlock a mountain of supply.
So true.
That's the missing piece. 6.5 doesn't allow much supply to be unlocked. And if you're like 6, like in my mind, 6 is the worst rate on the planet. 6 flat, 5.99, worst on the planet.
Yep.
Oh, but 4.5, 4. I actually think if we had a 4% mortgage rate, it would shock the world. Now transactions would go through the roof,
Yeah.
but I don't I don't know that we'd have crazy price appreciation because everything would be retrading and there'd be lots of choices. I mean, it would be a wild market. But I actually think like a 5.99 that causes prices to spike. I don't know that 4% does, and that might confuse people, but it's absolutely supply and demand driven.
No, that's such a good point and great point, and I mean, I don't know if I want to say fortunately, but we're probably not going to get that. This is a very hypothetical
We're not going to 4.
situation.
We're not going to 4. We're not going to 4.
5, 7, 10, who knows? But the logic, if I'm trying to communicate and piggyback off what you said, it's the issue that we have right now is the supply, and what happens is the demand increases every quarter, even half a point, like we saw
Every
in the end of
quarter. It's just
December, significantly too much to be able to comfortably have the market sustain with the current supply levels that we have. Now, if you go to 4, 4.5, why for the listeners? I mean, look, the people that have been trying to sell their homes are okay now going from a 3 or
yeah,
three and a
you're okay.
quarter, 2.75 to a 4, 4.5. I'll put it on the market. They're
Yeah.
not okay going from a 2.5 to a 6.5. And that's a big crux of the problem.
Yeah, so it's going to be really interesting. Again, I love you being on the show. Love you being at the event over week. Thank you for coming out. Thank you for
Well,
being
thank you.
a sponsor. I actually want to ask because again, one of the reasons Convoy is here because you play on both sides, conventional and DSCR or non-QM. And one of the things that we've heard a couple of times from you over the last 2 years is there are moments where I'll call it Wall Street, correct me if I'm wrong, is ahead of conventional. And how would we see that in the numbers? That would be where DSCR rates, all else being equal, are below. Yes, folks, it can happen. Not often, but it can, where DSCR loans are below conventional. So where are we today?
Yeah, it's this is one of the first times that I've actually disagreed in a good and bad way, that right now DSCR rates on an investment property are cheaper than conventional rates by about a quarter point. Okay.
Wow.
Last week they were equal. Like 3 weeks ago, they were a quarter point higher. So it's always a teeter totter between who's lower, higher, equal. There's been points where DSCR has been 0.75 higher.
Yeah,
Okay.
I
And
remember. Yeah. Mm-hmm.
I've always had quote unquote Wall Street's back, in that Wall Street, I do firmly believe, is more forward looking and a little bit more
Yeah.
intelligent, smarter, better at predicting where the rate environment is heading than just a knee-jerk reaction to the 10-year with
Yeah.
conventional Fannie Freddie, right? That's
Yeah.
just,
That makes
there
sense.
is no science behind conventional rates, right? There is a little bit of science behind where non-QM rates are. So with where I mean, in the last 2 weeks seen rates go where we've had, the even Fed minutes didn't necessarily hurt, but it didn't help,
Didn't
right?
help. No, didn't help.
Where we're going would tell me, if you look at Wall Street's normal kind of difference in rates between DSCR and conventional, is that DSCR should be about half a point higher right now. It
Right.
shouldn't be a quarter point lower. It's a strange position that I've seen. And for those that are listening, unfortunately, I have been a part of this in the past where DSCR and non-QM, just because you lock something, I don't want to scare anybody here, but just because you lock something with DSCR, ultimately it does not mean, as crazy as it sounds, it does not mean that your rate will not change by the time you get to the closing table. Okay. It sucks. And I might be bringing this up to some of you viewers that might be shocking and might steer you away from non-QM. That's not what I'm trying to do here.
Yeah, just
I'm trying
reality.
to keep it exactly 100% real, because I went through it at the end of 2020, beginning of 2021. I
Yeah.
went through it in the middle of 2021. And the biggest reason for people to understand is that in the non-QM world, there are no forward commitments
Right.
on locks. Okay. Most of the times, like, for example, if I lock a client that's at, let's say today, 6.75,
Okay.
right? I lock it for 30 days. We close and I go to one of our favorite, which I'll keep as our supposed to NBA Wall Street fund. And they're trading at 7%. Fine. I'll take the hit, right? I'll spake that quarter point difference, give it to the client.
Right.
In 2021, there was a point where we went from 3.3 to 4.3. Okay. And you've got hundreds, 200, 1,000 loans in your pipeline as a lender. You cannot pay that difference. You close doors down right away. And if I'm rambling a little bit, I apologize, but this
No,
is
I want to
somewhat,
let me relate this to the audience.
yeah.
The folks, non-QM, they're making commits forward looking, but there will be moments in time where new non-QM, aka Wall Street, freaks out. Think about the pandemic 2020 April. I know plenty of people who had deals in the pipeline. It might have been March, actually, March or April, that they couldn't get funding because the Wall Street turned off. I had people signed waiting for wires, and it didn't come in. When Wall Street freaks out, the rules change. Now, what Dustin is talking about here is he's not telling you that DSCR loans and this, that, you can't get locks. He's just saying sometimes in the business environment, there are moments where Wall Street freaks out and stuff gets immediately repriced. Unlike conventional, where it's having these daily movements, in my opinion, not your words, these are my words, Wall Street has moments of freak out, and they could go up or down pretty widely.
Yeah, and then the contrary is that, look, if you're doing a Fannie Mae loan, or government, Fannie, Freddie, whoever you're using, they have enough to stomach an increase in the rate if the rates go up, right?
Yeah.
There is
In your little loan. Yeah.
Exactly. But look, this is what I think. Everybody thought it was all good and gravy, and the grass was as bright green as it could be heading into 2024. But we had one of our, I'm going to say, in our top 10 rotation, if you will, for investors that we use, essentially go from about 500 employees 2 months ago to 8 as of last night. Me and John were on a call with one of the VPs who's actually a co-owner of the company at about 11:30 at night for an hour, trying to see who we can take from him, hire, etc. But his pain points that he went through, they went from 500 employees to 8 in a matter of 2 months. Okay. The rest of the employees fled to other competitors. And the reason being is because what I just went over, in that he had so many loans that he was not able to get forward, commitments on, that he went to his investors on Wall Street and they said, kick rocks, pound sand, pay us the difference in the premium, or we're not buying the loan. So he had to basically do what's called a scratch and dent on all of these loans, which was between us over 100 million in loans. Okay. Where he was taking pennies on the dollar in some cases, a bigger haircut depending on the loan criteria, but that put them out of business in a matter of 2 months. Okay, so when I'm talking, that we're not out of the woods yet, it's
Yeah.
true because we're seeing it still, but it's just not being brought up in the news because everybody's just looking for when are we going to see 5, 6,
Yeah. Rates are
percent
going
interest.
lower. Rates are going lower.
Yeah,
Wow, that's amazing. 508 people, all because basically what I think you're saying is he had loans in process and commitments. And then when they finally got closed, they were being repriced, and they're being repriced at such a level where he has to eat margin and bingo bango
he
gone.
couldn't. Yeah. It's
Ouch.
sad. Don't I love the guy, I love the company, and it's for the other broker owners listening, I'm sure you feel kind of my stress or pain going through it because it's something me
Yeah,
and John deal with on a daily. Like,
I'm sure.
I can't see, for example, I cannot have DSCR rates go up 0.75 between now and like the first week of March because we're
Yeah,
currently we have a lot of in our pipeline that's under 7% on DSCR right now that
yeah.
it wouldn't be fun.
It wouldn't be fun. At the end of the day, Convoy Home Loans is a provider. As I remember, you were number 6 last year, or no, that was 6 in 22. When's the new rating or ranking or whatever it called comes
It
out?
it comes out in April,
Oh,
so
okay, April. Oh, another
we'll
month.
find out then, but we'll see. I'm
I'm
hoping we crack the top
yeah,
5
top.
or
There you
3
go.
or but yeah.
There you go. There you go. Well, you're amazing. The audience loves you. I heard some great feedback from the event, both you and your partner, Jonathan. Thank you for coming out, being a part of it. Where can
Absolutely.
people find you or reach out if they want to see what they can do?
Go to convoyhomeloans.com and click the drop down. There's a tab for you guys, one rental at a time, listeners. Thank you.
And again, folks, if you don't know by now, you got to put in that tag because if you do, you get Dustin here or his partner, Jonathan. And if you don't, well, you're not going to get one of those two guys. And that's not good. All right, guys, take care.
Thanks, Mike.